What is up? This is the Working Investor. In this video, we are going to do a comprehensive review of IDVO, a fund that has returned great total returns, good income, and good growth, especially shining over the past few months, and has been proving itself since inception. So if that's what you're looking for, let's check out the video. As always, nothing here is financial, tax, or legal advice. Please see all my disclaimers. So let's start first with a quick overview of this fund, and then I'm going to show you, we're going to compare and contrast this to other international income funds, and we're going to see and compare it to the overall S&P 500, and we're going to look at total returns, we're going to look at tax efficiency, we're going to look at risk-adjusted return and whatnot. So let's go down this list over here. So we have the IDVO ticker, came out in 2022. On their website. So it's been around for about 3 years, more or less. It has 67 holdings, but so they do a combination. It's basically international high yield dividend companies, and they do an overlay of cover calls on top of it. So they talk about the 3 reasons to go into this fund. Basically, they mentioned the 2 income streams, like I mentioned earlier, the dividends and the cover calls, so 2 ways to get income. They pay to you monthly. It's about 5.5% annualized, but that's, people may frown upon 5.5% dividends annualized, but it's a couple things. It's also the exposure, because it's not US, it's international. And it has pretty good overall return and total return as well. So you're not lagging in total return. So it seeks lower volatility. So they talk about the dividends and option income, reduce share price volatility versus overall market. And we're going to talk about this. I'm going to show you guys a portfolio visualizer comparison to show you how it lowers volatility and increases the Sharpe ratios. Professionally managed, so you are paying the management fee for being professionally managed, actively managed. As you see here, the expense ratio is 0.66%. And here you can see the overall strategy, and just pay attention that it's high quality international, large and mid cap companies, so no small cap. And we're going to talk about American depository receipts. Don't just blur over it, because it does have tax ramifications. When you get your distributions, how are you going to be taxed? If this isn't a taxable account, not a tax advisor, but I would say as a humble, retail investor, and I may be wrong, I think it has some tax benefits, more cost effective because it's an ADR. And I'll break it down a little later on. So here's a quick little summary of their top 10 holdings. And here they go down further into their methodology, where they focus on dividend growers, things that are sustainable to grow over time in their dividends. They also focus on sector allocation. So you're not just limited in the US because it's international. Well, I'll show you in a bit. It does have like 6 or something percent. It has some US, but you basically have the whole world is fair game, where they could find underlying companies that are outperforming relative to their peers, and the whole world is fair playing field. The downside is it's not like 1,000 or 5,000 different companies. It's basically focused on 30 to 50. So there are other stuff, Vanguard products, Charles Schwab products, a lot of these broad-based international developing market, emerging market type of ETFs that do give you much more variety of how many underlyings there are. So that's kind of like a bit of a downturn, but it could be depending how you play it. And then of course they have the tactical covered call writing strategy. So look at the country allocations, right? So you'll see here that the US is about 6%. Here I just highlighted for you 6.5% to be precise. And if you go to sector allocation, you'll see that it's not super duper heavy on technology. There is a chunk of technology, about 10.29% is technology currently. Now let's talk about their dividends. The dividends are monthly and they're pretty stable. I was going back, you see about 15, 16 cents. You go to 2024, 14 to 15 cents, 2023, 13 to 14 cents, 2022, 12 to 13. So if you notice the trend, 12 to 13, 13 to 14, 14 to 15, 15 to 16. So they've been very stable, very consistent historically, and they've been creeping up a little bit with their dividends. So that's pretty nice as well. Now, as you guys know for sure, on a practical sense, I'm a very practical guy. So in a practical sense, I want to know how are they performing compared to the S&P 500, right? Because I mean, of course, it's not an S&P 500 because it's not US, it's mostly international. But compared to the market as a hedge, are you giving up some possible upside? Because I'm always looking for underlyings that give me a hedge in my portfolio, but not just a hedge, but I want the hedge in itself to give me good performance as a standalone. So I'm not giving up good growth in the portfolio for sacrificing a hedge. So I want to get a great risk adjusted return, and the return should still be comparable somewhere in the ballpark of the S&P 500. So we're going to go first let's go year to date to show you the highlight, and then we're going to go 3 years. Why am I going to go 3 years total return? Because it's been around we don't have more data than that. And we're going to compare the S&P 500 to IDVO. And the big contenders out there that I found that are the best ones that I found was this Vanguard product, VYMI, and Charles Schwab had SCHY. And I'll just throw in VXUS, but that's not really like an income type of fund. So that's just like a bonus category because I do track VXUS a little bit. So year to date, as you saw, the market has been down. Right now, the market has been coming up, but so far, total year to date, just under 5%. IDVO has shown a contrast of being up almost 10%. VYMI, you would wonder, why would I not go into VYMI? Let's look into SCHY, which has done better year to date. But let's look at the bigger picture, VXUS 10%. Let's go to the 3 year, right? So let's look at total return. S&P 500 delivered 40%, right? IDVO has held its ground pretty well in the past 3 years. And in total return, but even by getting dividends, okay, 5.5% dividends monthly, but you can compound. But is the dividend safe? Yes. And I would say yes, arguably, because it's actually totally outperformed the S&P 500. VYMI, 40%. That's why I like IDVO, because I'm not looking at recency bias. I want to look at the whole picture as much data as I can. 3 years is better than having a few months of data. Charles Schwab, 26%. Total VXUS, 35%. So basically, I mean, VXUS obviously has way more stocks inside of it, thousands of underlyings inside of it. I mean, I have in one of my portfolios a combination of VXUS and IDVO, kind of to give me that diversification, but also the IDVO a little bit of an edge plus some income as well, overlay, like extra income overlay. But that's again not financial advice. It's something that I do. I want to disclose that with you guys currently what I'm doing. So that's why I like IDVO, because performance had held its ground pretty well, total returns. If you want to look at price return, you could see that IDVO gave you, as an income fund, gave you 27% price return. Not total return, of course, but price return. So having this stock, it's growing in price and it's giving you a dividend. And I would feel safe using this dividend if I'd be in retirement, again, not financial advice, because I don't have to sell any shares and my price of shares goes up. So if I ever want to liquidate and my price is going up in value, it makes it easy to liquidate because I'm not going to leave any money on the table. I'm actually going to have extra money and keep up with inflation. Next, let's look into the portfolio visualizer and let's compare some of the risk-adjusted returns with these underlyings compared to the S&P 500. So I'm using about 2.5 years of back testing data, starting off with $10,000. And we're going to compare portfolios that are 100% allocated to each of these. So we're going to have the Charles Schwab is the first one. The IDVO, which we're talking about, is the second one. The Vanguard, VYMI, is the third one. And then the S&P is the baseline that we're going to compare to. So over a 2.5 year period, as far as total balance, you'd see that, let's see over here, Charles Schwab, 12,800. So IDVO would be almost 14 grand. I guess the VYMI, according to the portfolio visualizer, is giving me different data saying it's 14,000. S&P 14,098. I'm not sure if this is 100% accurate because according to the Seeking Alpha, the IDVO has higher total return, so you'd expect it to have a total value greater. So I just want to show you there are sometimes discrepancies between different databases. And here we're using 2.5 years of data versus 3 years of data. So, it's somewhere in the range, you know what I mean? But here it's saying it's probably underperforming, a little bit the S&P 500. But, the CAGR, the compounded annualized growth rate, look at IDVO 15.48, and they're saying S&P like 18.9. So I'm getting different data. But look at basically best year and worst year. You could see here the worst year for IDVO is 8% versus S&P 500 negative 5%. So it has basically showing more stability. Let's go to max drawdown over here. So, around 10%, and then IDVO 7.5%, S&P 8.33%. So you're getting like better, less max drawdown. The Sharpe ratio, the higher the Sharpe ratio, supposedly the better risk adjusted return. So you see here that IDVO 0.84 Sharpe ratio, S&P 1. So they're saying that maybe it's under, based on this data, the S&P is delivering more, then it's more. But then if you look at the benchmark correlation coefficient, so they're saying that it's not, the lower the number, the more, uncorrelated it is to the market. So they're saying it is 0.75%. So it's moderately correlated to the S&P 500. So they're saying the other funds may be a little bit better when it comes to correlation coefficient. But this is from the portfolio visualizer. Now we're going to talk about the brass tacks. If I would suggest to go to the tax section, they have forms called 19A. And then if you go down, see Ford 19A1, and they tell you about return of capital. And then there's also I was going down to the most contemporary of the previous year, 2024 primary, layout report. So let's first break things down for a second so you can understand what I'm talking about. Again, this is coming from not a tax advisor, so please double check I might be inaccurate. So when it comes to distributions, right? Distribution is like a basket term. So what does it mean? Let's break down distribution. So there's 3 components. There's sometimes more, but for purposes of IDVO, I found 3 components, right? I found ROC, which means return on capital or return of capital, right? And what I understand is if you get a dividend or a distribution, let's say, and a portion of it is considered return of capital, you should be theoretically 0 tax on it until you've received your initial investment. If they label that return of capital. So if you have $1,000 and over 10 years, it took you to get the full $1,000 back in return of capital. Only after 10 years, then you pay, you have to pay taxes. But until you get the return of capital back, it's the government looks at it like you're getting your own money back in your pocket. It's not considered a taxable event because it's not considered income. Again, this is from a layperson. And then there's something called qualified dividends. So qualified dividends in general, has a more fair tax rate, tax treatment. It could be 0% tax to 15 or 20% tax rate, depending on your tax bracket, up to 20%, if I understand correctly. So it's typically more favorable and more tax effective. And then there's a portion of the distribution termed ordinary dividends, which is the highest tax rate. And then when you get international dividends, a lot of companies, you would have to pay, a lot of countries charge you tax, when they give you the distribution because you got to pay their taxes. And then there's a treaty that, we don't get double taxed with a lot of countries. We have certain rules like a reciprocity, or we don't get double taxed. So we have to look at how much they took off and then get the adjustment and not have to pay the taxes. But if I understand correctly, I think that it would not be considered qualified dividend. I think it has to be U.S. companies. I have to double check that. But the ADR is basically everything is considered even though you're getting dividends from international companies, because it's American depository receipts, it's treated all as U.S. So let's look at the breakdown in the form. So first we're going to look at the 19A, and then we'll look at the whole general from 2024. So this is looking at the most recent distribution. There was a dividend payment of about almost 16 cents. And now what percent of it? So you can see here the total, the bottom is about 16 cents. But a portion of it, about 5.5 cents, is considered return on capital. That's about 30%, 35%. So 35% of the distribution is considered return of capital, and 65% is considered, pretty much you're getting your, So basically, you're not taxed in that 35% until you get return on capital. Now let's look at the big picture from 2024, and we'll see how the breakdown works even more. I know there's a lot to unpack over here, so I'll break it down. So let's focus here of IDVO. This is what we're talking about. They have all their tickers that they list. And here are the 12 monthly distributions, right? And if you look on top over here, record date, X date, payable date, let's focus on, so you see here it says total distribution. So look at the bottom, the total distribution was $1.83 over the year of 2024. That's total distribution, basket terminology. Of the total distribution, I'm going to be honest with you guys, I'm still trying to figure out how this makes sense. So theoretically, box 3 non-dividend distributions, what I understand is that should be return of capital, but the math doesn't really add up. So that's a portion. And then there's certain a little bit is foreign tax paid, which I guess should have some ADRs. I guess there is a little bit of foreign tax paid. And then you have here qualified dividends and, this is the qualified foreign tax paid, and then qualified, income dividends versus ordinary dividends. The point I want to bring home is that the dividend distributions they give you, some of it is considered qualified dividends, and some of it is considered ROC, and some of them is ordinary dividends. So it's kind of a mix of, it's a whole blend, and I guess there is some foreign tax that was taken off, which you should, if there's some reciprocity treaties, there should be some kind of tax credit. But if you notice, a very small percent is that. So currently I've added a small position of IDVO. I'm looking to build it up to approximately 1 to 2% of my portfolio, trying to basically edge out some of the risk that I have. I have a lot of risk for my YMX position. But again, let me know what you guys think about it. Are you guys interested in this fund, not interested in the fund? What are the pros and cons you guys see? Anyways, this is The Working Investor over and out. I hope you guys have a wonderful trading week.